Kia ora and good evening, everyone. Fantastic to be back with you on the slightly more drizzly, miserable Auckland night. Thankfully, the economy is not in quite as much of a downbeat, miserable position. We are starting to see a bit more of a upbeat economic tone coming through. We're seeing as we head through the year that we start to shift gears. Now, to be fair, I've never owned a manual car and couldn't drive one if I tried, but I'm led to believe that if you go from reverse into fifth gear, you generally stall it. Same sort of thing with the economy. We're not expecting it to go from what was a pretty tough 2024 immediately into a much better rocket ship to the moon economy this year. But we're starting to see those shifts. We're going through the motions. We're going from reverse now into neutral, then into first and second gear as the engine warms up a little bit more. To be fair, for all of you in this room, you're thinking about in various ways, shapes and forms what is happening in the housing market, and it's been quite a lot to take through in the last couple of years, even in the last 12 months. You can see here that the interest rate outlook, and let's be clear, that's pretty vital when you're thinking of buying a home, has been hugely variable. If you go back to May last year, the Reserve Bank was telling everyone actually interest rates need to remain higher for longer. Heck, they might even pitch upwards. And we all took that message and went, whoa, okay, economy's not getting all that much better all that quickly. It's still going to be a pretty tough environment for a while. Come through to August and they said, look, sorry guys, got the date wrong. Ignore that May prediction. We're now well on the way to seeing interest rates coming down. Cuts were starting to move through and there was that sort of better economic environment starting to emerge as interest rates dropped. You can see that sort of continued as we've gone forward, and in the last set of interest rate forecasts that the Reserve Bank has made, they expect the official cash rate to continue to fall through this year, bottoming out somewhere around sort of 3% or so. Probably most importantly is that we're not getting back to those low levels that you saw during the pandemic itself. I do talk to some people sometimes who go, geez, it'd be nice to have that 2.2% mortgage rate again. Yep, but the economy's probably on fire at that point, so we're not likely to get back there. As you'll see on the chart behind me, where interest rates are likely to level out from an OCR point of view is higher than what it was back in 2019. We're not trying to stimulate the economy, we're just trying to stop sitting on the brakes. So no accelerator, no brake, just trying to let the economy coast a little bit more in the middle. And that's what we're expecting to see in terms of the economy revving back up. Not speeding, just getting back up to the speed limit a little bit more. We know that all of this is coming about because inflation is back in the box. You're not seeing as many increases in prices, or at least of the same large degree as you did the last couple of years. There's sort of quite a variety there that you can see on the charts behind me. The likes of services inflation, paying for people's time, there's still a fair bit of pressure there, as well as that the likes of non-tradable or domestically based inflation, that's still pretty hot as well. You know that people are paying higher rates, higher insurance, and the likes. It's the other stuff though that's put us into a slightly better position. You can see the likes of that goods inflation now at a lower level, sort of below 1%. Someone said to me the other day that that's because everyone's looking for discounts. And in fact, someone over the Christmas break said they wouldn't go to Briscoe's for anything less than a 70% discount, which I thought did highlight to me just how much that was coming through. What we're also seeing though is the overseas-based inflation, the lowest line on my chart, it's starting to slowly turn around, and that's sort of a little bit of a worrying sign, not immediately making us rush out and worry hugely, but also saying that, look, when there's a little bit more of that inflation risk, the Reserve Bank is taking a pretty strong view that, yep, interest rates will continue to come down, but again, just towards neutral. They're not trying to overdo it because they don't want inflation to come back strongly again. Let's talk about some of the national trends that we're seeing out there in the economy, and both the good and the bad. The best one, and probably the best economic indicator we've got at the moment, is around spending activity. Now, I could stand here and we could talk about GDP all night. I'd be wrong every 5 seconds and you'd all go to sleep and get bored pretty quick, so let's not do that. Much better economic indicator, how much are we spending? Because if there's cash going out into the economy, clearly people have got the money to spend. If there's not spending happening, either of two things have occurred. Either people don't have jobs, so they don't have money to spend, or they do have jobs, but they're too worried about things and they're keeping their money in their pocket. And that's what you saw for a great amount of last year. Interest rates were high, people had to put the money on a mortgage, they couldn't put it as much out into the other parts of the economy, and you'll see that spending dipped away until about mid-year. From about July last year, things started to pick up ever so slightly, wasn't huge, but that sort of continued through the last couple of months as well, and spending activity is now sitting about 2.7% higher than it was at that low point. You'll notice as well a little bit of a spike in that upwards chart. The rest of it's quite a smooth line apart from that. That's December. And that's when we all did a little bit more Christmas shopping than normal. And interestingly, we saw the biggest increase in Boxing Day spending, 13% gain, biggest in a decade. And that's increasingly because it looks like, again, people are still a little bit cautious. They're doing a bit more bargain hunting, but when they find a good bargain, they're willing to put their money out there. So again, bit of a shift in tone. I think through most of last year, we had people, they weren't thinking about buying houses, they weren't thinking about spending money, they were sort of all looking into themselves. This year, a bit more talk that starts to come about. People aren't necessarily committing, but they're starting to think about their options a bit more, and I think as we move through the year, that talk will move a bit more into action. We know that other parts of the economy are starting to show a little bit more of a lift as well. You can see on this chart, lovely squiggly lines here. Long story short, manufacturing activity in New Zealand expanded for the first time in about 23 months at the start of this year. Not huge, still 1 month out of 24 that have only gone up when the rest have gone down, but it's a bit of a shift again in just how people are starting to think about the economy. There's a few more orders coming through, a little bit more economic momentum that starts to build up, which is helping with that confidence. And of course, the primary sector is doing well as well. Now, of course, here where we are in Auckland, there's not too many farms right next to your property, but at the same time, you are starting to see that lift coming through from other parts of the country. The lift in some of these commodity prices, you can see dairy's in a better place, horticulture's making more money, we're selling good amounts of kiwi fruit, of apples and similar overseas. All of that means that for dairy alone, there's $4.5 billion more this year coming into the New Zealand economy. So again, from a point of view where interest rates are now coming down, a bit more cash for households to spend, a bit more activity from farmers, they're spending a bit more. Again, not revving up the engine too hot and too fast, but a little bit more momentum that starts to show through. And importantly, we're also starting to see some better trends coming through in the jobs market. Unemployment is still increasing at the moment, and that's incredibly tough, and we expect to see that sort of cap out in the next couple of months. But interestingly, for the last couple of months, as you can see on the chart, the number of job ads out there in the economy, the number of positions that different businesses are advertising to try and fill, they've stopped falling. Because man, were they falling hard the last year and a half. Real pullback, not as much activity, businesses clearly don't need as many people. But the last sort of 6 months or so, it's been sort of jiggling along the bottom a little bit more. Again, hasn't started to lift massively, but just starting to show through in the middle that, again, bit more momentum, a few more businesses going, actually, look, I'm not super confident, but I'm a bit more confident of activity to come. And so I'm going to stop the sort of hiring purge. I'm going to start thinking about a few more roles every now and then. What does that mean for the housing market? Look, things are still sluggish out there, but there is, I think, as potential buyers, there's still quite a good amount of opportunity out there to wheel and deal and get things going. Again, if your reference point is when interest rates were super low, you're probably out of luck because we're not an economic catastrophe quite as much as we were back then. But equally, we're nowhere near the levels where you had house prices just going up and up and up hugely every day. Things are a little bit more settled than that. We had new data out today, coincidentally, that showed that house prices increased about 0.2% over the last month. Not huge, we're not expecting it to be huge at this point, but just a little bit of a lift, which indicates that we're probably at or near the bottom of the house price market. Things are starting to show a little bit more of an increase. House sales are starting to increase as well, albeit from quite low levels. The biggest thing, however, is that there's a lot of stuff on the market to purchase at the moment. And from a buyer perspective, you've got some options out there because there's currently about half a year's worth of current house sales out there available to be purchased. People have put their homes on the market, they're looking out there for options, and increasingly the only way that they're able to make that sale happen is by saying, look, I'm willing to either drop the price or sort of make this work for you. Increasingly, there are quite a lot of options out there. You can see these stock listings are quite high. So there's a lot of different opportunities. As I say, although the number of houses available to buy has gone up, the actual number of sales hasn't pushed quite as much higher. And so that does mean that, again, people are still a little bit reluctant to make those big commitments. They're still wheeling and dealing a little bit more. It's taking a bit longer for people to move from the talking stage to the action stage. And you can see that with these sales numbers. Ever so slightly starting to lift up, a bit more momentum's coming through, but sort of from that lower level. And I think increasingly what you're starting to see is that people are going, look, mortgage rates are coming down. It's a bit more viable now. I can actually go to the bank and they'll actually start to lend me some decent money. I can see that there's an option here. I can see that I can make it work with the job and the income that I've got. Not going to jump feet first in, but I'm starting to sort of kick the tires and test the waters a bit more. What does that all mean, and how has that come through for house prices? Long story short, they're moving sideways, but you can see that they're moving sideways after some big ups and some big downs. Through the likes of the pandemic, you had house prices that just massively jumped up, and again, to sort of levels that were a bit insane. And the challenge, of course, is that for some people that bought in that time in the market, things got pretty difficult for them. I think I've spoken to a group like this before to say that one of my good friends in Wellington bought her first house in the middle of November 2021, right at the peak of the market. And at one point last year, she had to find an extra $60,000 to pay the mortgage, and she'd lose $300,000 if she had sold it at that time. Thankfully, things have turned around now. You'll see that house prices are a little bit more level, they're moving a little bit more sideways, and that's meaning that people are a bit more confident about what the market means. No one likes it when it's topsy-turvy. If you're going sort of through the rinse cycle, no one's trying to make decisions. Everyone's going, I'm going to wait till it calms down. Now that it is a bit calmer, now that you're starting to see interest rates come down, there's a little bit more momentum. People are going, actually, now is probably the right time to dip my foot in and I won't be tripped over by it. We expect as well that house price growth might be pretty subdued for the next couple of years as well. And that means that, look, if you're buying a house to flip it 3 days later for a cool $1 million profit, that's probably not the right time to be in the market at the moment. It's not going to happen quite as much. But for people who are going, actually, look, I need to put a roof over my head. I'd like it, maybe over time to make a bit of money, but actually I just want to stop paying rent. I want to think about that option that I've got for me and my household and my situation. You're starting to see, again, a bit more stability out the middle. So flatter prices recently, likely to be flatter prices as we head through into the next couple of years. The other thing we're seeing is that there's a little bit more confidence showing through in the building market. And that's often only when the building market thinks, actually, there's got to be some opportunities out here. I'm not just going to keep building houses when there's no one who's going to buy them. And so the fact that you can see here the number of building consents issued across the country has started to level out. Again, previously, crashing hard, definitely on a big downward swing. Last couple of months started to level out a little bit more, is again suggesting a little bit more momentum. Now, I don't want to overstate that. Again, we're not rocket ship to the moon economics tonight, but it's very much a little bit more of that tone shift. People have gone from quite depressed about the economy into an all right-ish position, still a bit cautious, and as those interest rates continue to come lower, a little bit more starts to emerge. The biggest and most interesting part is that in the New Zealand housing market, for quite a while, investors were a big part of it. They drove a lot of price changes, they drove a lot of activity. As you can see on this chart, not to get too technical, but basically this chart looks at how much are you going to earn if you're an investor buying an investment property, how much are you going to get from the rent, versus how much would you get if you just went to the government and said, I'll give you $10,000, you give me a good bond rate at the end of it. Bond rate, you'd have to do no work for, you just sit there and the government pays you. Rent, you have to do quite a lot of work for if you're a landlord. And so what we're seeing at the moment is that it's almost even Stevens. It's not quite as useful for people to get into being a landlord at the average. Now, why do I show you this? One, to highlight that hopefully there's not quite as much pressure from landlords at the moment to really be pushing the gates out. But what it does mean that landlords who are starting to get a bit more active in the market, they're looking for that deal. And that's where I think probably a lot of first home buyers are going through as well. So for good homes, there's still always going to be a bit of competition. You've definitely got the ability, though, to look through those options because investors, they're sort of a little bit in a different position as well. And lastly, of course, KiwiSaver is quite vital. You're starting to see that the numbers are coming up and up and up in terms of how much people are taking out. About 44k was the average withdrawal for a KiwiSaver exit for a first home purchase, which I think is showing that as people save up more over time, yep, that's the way they're using it. They're trying to get into the market. They're trying to sort of make sure that they're securing their future as well. The last and most important bits is that we do expect that the economic motor will continue to rev up this year. And that's very much driven by that interest rate outlook. Very much so, how low interest rates go and how they eventually get there will determine a lot of this economic activity. At Infometrics, we've calculated that between October last year, which is sort of when peak interest rates were in terms of how everyone had flowed through to now, you're seeing something like $8 million a week in additional spending hit the economy. People are paying less on their mortgages, they've got a bit more free money to spend. Not all of it's going to the shops immediately, but again, as people get a bit more confident, it starts to come through. End of this year, we think that $8 million increases to $45 million a week. So again, a lot more activity, people are starting to become a bit more confident. And that's very much because interest rates are coming down. Now, you'll get much better insight into what that means for you personally in a moment, but I think it's just worthwhile showing you some of the actual retail rates that are on offer. These are averages that the Reserve Bank puts together. Everyone offers something slightly different, but you can see that sort of continued push lower over the last couple of months. What's also important is just because you know interest rates are coming down doesn't necessarily mean that the shortest possible rate is the best possible rate. Now, I'm not going to give you direct financial advice. You've got to go and get a proper advisor for that. But you will note here there's a bit of a gap between the likes of the orange line for the 6 month and the red line for the 2 years. That means that, yep, some people are going shorter, but that's not always the best situation, depending on where your risk tolerance lies, what you think is going to happen in the market, and similar. All I'm saying is don't just sort of bet the house on one thing definitely happening. Cast around, have a talk to the professionals, have a think about what that means for you. Because we know that people are increasingly in that position. They're a bit more confident and they're thinking about what that means for their own lending position. This last chart, and I promise it's the last chart, looks at the level of new mortgage lending by how long people were fixing that lending for. Now you can see back in November, the second to last bar before the 25-24 line has a very large, around about 50% of new mortgages that were being fixed for just floating terms. That's because at that point you had to float for a couple of weeks before you had the Reserve Bank decision, and then you had 3 months after that where they didn't make another call. So quite a high proportion there, but a lot of people also fixing for that shorter period of time. Everyone is revved up a little bit more for the housing market and for the economy to get better this year. We're not expecting, like I said before, it's not rocket ship to the moon stuff, but it's that gentle sort of ticking over of the economy, getting into a better position. People have a bit more money. After a couple of months, they start to spend a bit more of that money. As a business, they wait for a couple of months of good sales. Maybe they're ready to employ a little bit more as well. And so we do expect that over this year, that economic momentum starts to rev up. People are generally thinking that things are getting better from particularly mid this year, and you're starting to already very much see those green shoots. With that, the long story short is there's quite a lot of economic material that's coming through at the moment, a lot of ups and downs, and if you're looking at anything that's happening from the US at the moment, you probably don't know what way's up or down, given how many different tweets are coming out from the new US president. Look at the things that you can control, and importantly, that means what are your current finances looking like, what do you think is going to come up next, what support can you get from what different quarters, and how does that all play into where you want your money to work for you in the future. So there's definitely a bit more momentum, but always, of course, pays to keep your wits about you. I'll leave it there and pass back. Thank you very much.